Welcome back to the deep dive. If you want to take the pulse of the U.S. economy, of the American stock market, there is really one benchmark that matters above all others.
The S&P 500.
The S&P 500. It's the collective performance of the largest, most successful, most stable companies in the country.
It really is the gold standard.
So our focus today is on a company that has just completely outperformed that benchmark. It's emerged from, what, a decade of being in the shadows, really, to generate a spectacular return.
Oh, spectacular is the word. We're talking about gains of 512%.
512%.
Right.
And the S&P 500 over that same period, just 11%. As of this deep dive, anyway. It's just a massive gap.
It's an astronomical gain, and it's the definition of a successful turnaround. The company we are unpacking is Sandisk, the flash memory specialist.
Sandisk.
And they are scheduled to join the S&P 500 on Friday, November 28th. Now, to really emphasize how big a deal this is, Sandisk is one of only 12 companies to make the grade this year.
Only 12. That really puts their performance into perspective. It's not just that they've made investors a lot of money, it's that they've met these incredibly stringent requirements to be considered, one of the market elite.
Right. Getting into the S&P 500 club is famously difficult.
So what are the criteria?
Well, they're all about stability, size, and structure, not just, a hot stock price. You have to be a U.S.-based company.
Okay.
You need a market capitalization over $22.7 billion. And you have to be highly liquid, which means at least 50% of your shares have to be available for the public to trade.
And then there's the final hurdle, right? The one that usually trips up the high flyers. Profitability.
That's the key differentiator. They require GAAP profitability, that's generally accepted accounting principles, in the most recent quarter.
But that's not all, is it?
No, and this is the real challenge. You also have to have been profitable across the preceding 4 quarters in aggregate. It's a measure that's really designed to ensure sustained financial health, not just a one-off hit. And Sandisk has managed to tick every single one of those boxes.
Okay, so let's unpack this. We have a company that was, for all intents and purposes, dormant. It was stuck inside a much larger corporation, set free just a few months ago, and now, boom, all this momentum. How did this happen so fast?
That's exactly what we need to trace. And it starts with the company's corporate history, which has been, as you put it, a long, strange trip.
Right. Sandisk started as its own company, right? IPO back in '95. For 2 decades, a huge player in data storage. But then in 2015, Western Digital acquired them.
Yep. And the goal was classic M&A. Create a data storage powerhouse by merging these 2 giants.
Good intention?
The intention was good, but the execution, maybe not so much. What you had for years was suboptimal performance. The flash memory business, which was Sandisk, was arguably being held back by being tied to Western Digital's legacy business.
Okay, and this is where we need to stop and really define that core problem, because this is why the split created so much value. When we say Sandisk, we're talking about NAND flash memory.
Exactly. For our listeners, just a quick refresher. NAND flash is that non-volatile storage, meaning it keeps data without power that runs everything. High-speed solid-state drives, your smartphone, and most importantly for this story, the massive server farms run by cloud providers.
Okay, and the problem was the parent company, Western Digital, also ran the hard disk drive, or HDD, business.
And those are 2 fundamentally different worlds.
How so?
Well, the HDD business is mature. It's slow growth. It needs huge capital investments, but for manufacturing, that changes very, very slowly.
Right.
NAND, on the other hand, is high growth, high risk. It needs constant, massive R&D spending to keep shrinking the tech and packing more data in. When you put those 2 under one roof,
The fast-moving one gets starved for cash.
precisely. The high R&D NAND division had its growth potential throttled because the whole company had to serve the capital needs of the slower, older HDD business.
So the structure itself was the problem.
Uh-huh.
And that's what caught the eye of activist investors.
It did, most notably Elliott Investment Management. They stepped in, and their argument was pretty simple. This combined structure is fundamentally flawed. It's preventing the flash business from hitting its potential.
And a solution.
Split them up. Separate the businesses and maximize the value of each.
So this wasn't really Western Digital's idea. This was a corporate divorce, basically, engineered by outsiders who saw this hidden potential in Sandisk.
That's exactly what it was, and the campaign was a huge success. The split was announced in late 2023, and it was all done by February 2024. The high-growth flash memory part. It got to keep the name Sandisk.
And that separation is the inflection point. That's where this 512% outperformance comes from. It's all driven by investor enthusiasm for this newly focused, independent Sandisk, plus some really strong execution on their part. It's like a textbook case of unlocking value.
And the early financial results, even though, we don't have a full year of standalone data yet, they absolutely confirm that this enthusiasm is justified.
Let's get into those numbers.
Okay, so their most recent quarter, their fiscal 2026 first quarter, ending October 3rd, Sandisk brought in $2.3 billion in revenue.
Which is a pretty big jump.
It's a very robust 23% increase year over year and 21% sequentially. That kind of trajectory shows they just, hit the ground running.
Okay, but now we have to talk about the profitability figure, because if you just read the headline, it looks a little concerning.
It does require context. So adjusted earnings per share, EPS, came in at $1.22. That was reported as a 33% decline. But analysts looked right past that.
Why?
Because Sandisk was very clear. They said this decline was entirely due to one-time startup costs and separation expenses.
Can you break down what startup costs means for a company that's been around for decades?
Right. So when a company splits, it has to literally recreate its entire operational infrastructure. We're talking new accounting systems, new IT architecture, separate legal, separate HR departments.
All from scratch.
All from scratch. These are massive one-time expenses. Analysts see them as non-recurring. They basically just removed them from their future models, which is why the stock didn't blink at that EPS decline. The market is focused on the revenue growth and the future.
And that future all hinges on one area, the data center memory market. This is where the new independent Sandisk is placing all its bets. It's not just about consumer electronics anymore.
Correct. And that focus is paying off. While their overall data center revenue was down 10% year over year, that's probably some leftover noise from the parent company's sales cycle. The number that matters is the sequential revenue. That jumped 26%.
That's the real indicator.
That's the indicator that their new strategy is gaining traction and fast.
And they're not just making product. They're making real, concrete inroads with the biggest customers in the world, the companies we call hyperscalers.
This is critical. For anyone less familiar with the jargon, hyperscalers are the giants of cloud computing. Think Amazon Web Services, Microsoft Azure, Google Cloud.
The biggest buyers of this stuff on the planet.
By far. Their orders can move the entire market. And Sandisk has been very open about their progress here.
So what's that progress look like?
They've confirmed they have 2 major hyperscalers in the qualification stage right now. That means their products are being stress tested for performance, reliability, you name it, before they get approved for huge deployments.
Okay.
On top of that, they're planning to engage with a 3rd hyperscaler and a top storage OEM for calendar 2026. They are actively engaged with 5 of these huge customers in total. This is serious execution. It shows they're positioning themselves to be an indispensable supplier.
Which puts them right in the path of this massive demand wave from AI. And I assume management is expecting this to translate into a huge jump in profits.
Absolutely. Their own guidance for the near future is forecasting revenue to climb to $2.6 billion and adjusted EPS to hit $3.20.
Wow.
So that shows you they expect those hyperscaler revenues to really kick in just as those big one-time separation costs are falling off the books.
That kind of performance, combined with the S&P 500 news, must have sent Wall Street scrambling.
Oh, analysts had to immediately just tear up their old models from the Western digital era. After that financial report, Sandisk got hit with a dozen price target increases and at least 1 formal upgrade. The consensus just shifted overnight to being overwhelmingly bullish.
How overwhelming are we talking? Is it pretty much universal?
Remarkably so. Out of the 18 analysts covering the stock, 12 rated a buy or a strong buy. And maybe more importantly, there are 0 sell recommendations.
0 sells.
That's a rare level of conviction, especially for a company that was just spun out.
And what about price targets? What kind of upside are they seeing?
The average price target is sitting at $258, which at the time of the report was about 17% potential upside. But some are way more aggressive. CJ Muse at Cantor Fitzgerald, for example, he has a $300 price target. That suggests another 36% upside is still possible.
That's a huge level of conviction. But let me ask you this. Given how volatile the memory market can be, it's known for these boom and bust cycles, isn't betting everything on NAND just inherently riskier than being part of a diversified company like Western Digital was?
That is a fundamentally important question. And yes, it is riskier in terms of exposure, but right now the market is rewarding that risk. And it's because of the underlying supply fundamentals. The core reason for all this bullishness is that the NAND supply market is tightening, and it's tightening fast.
What's driving that?
It's AI. Analyst Muse and management, they both confirm that this massive, sudden demand from AI and generative computing is just sucking up all the available capacity faster than anyone can build it.
And this isn't temporary.
No, the thinking is this could lead to actual shortages that extend through the end of next year.
And what does a potential shortage do to the behavior of those big hyperscalers?
It creates a bit of panic, or at least a need for stability. If you're a data center operator and you need guaranteed supply for your AI build-out, you are now proactively signing long-term agreements with reliable producers like Sandisk to lock in your supply and your price.
So it's accelerating their strategy.
It's pouring gasoline on it. It's cementing the data center segment as their biggest market even faster than they probably expected. The timing for them, as a newly independent company, is just, it's perfect.
It's fascinating, though, that they're getting all this celebration, the S&P 500 inclusion, without a full year of clean, standalone profit data. That must make traditional valuation tricky.
It absolutely does. You can't really use earnings-based metrics like the PE ratio. It's useless right now because of those one-time separation costs messing up the numbers.
So what are analysts using instead?
They're forced to look at a sales multiple. Right now, Sandisk trades at roughly 3 times forward sales.
And is 3-time forward sales considered attractive in this space?
It is, especially for a pure-play growth hardware company. You know, a software company might trade at 8 or 10 times sales, but for hardware, it's lower. And when you look at comparable companies focused on high-growth data center infrastructure, some of them trade between 4 and 5 times sales.
I see.
So for Sandisk, a proven top 5 global player in NAND, capturing share in the hottest segment, yeah, 3 times forward sales is seen as a pretty attractive entry point.
So what did this all mean for you, the listener? We've really distilled a powerful story here. You have a successful corporate separation, one that was spurred by activist pressure,
Right.
and that immediately led to a massive stock surge, strong execution on a very targeted strategy, and perfectly timed entry into a tightening high-demand market. That is the entire blueprint for getting into the S&P 500.
And based on that strategy and the overwhelming analyst confidence, the case for Sandisk is extremely strong. It really is. But we do have to maintain some balance.
Of course.
While this performance is exceptional, it's always important to remember that multiple perspectives exist, even for the highest flying stocks.
Right, even with all this momentum. We know, for example, that the respected Motley Fool stock advisor team, they recently put out their list of the 10 best stocks to buy right now, and Sandisk wasn't on that list.
Which just reinforces the idea that, investment decisions depend on your methodology, your risk tolerance, your time horizon. Great performance doesn't guarantee a universal thumbs up from every single platform.
So we'll leave you with a final thought to mull over. We've seen the sheer power of this corporate reorganization driven by activist investors. The Sandisk story is immediate. It's sharp. How often does a corporate divorce, spurred by this kind of outside pressure, lead so directly and so quickly to this level of market outperformance and benchmark inclusion?
And more specifically, what does the immediate success of the separated Sandisk say about the strategic value and maybe the capital constraints that were previously locked inside that larger parent company? This whole story really forces you to ask how often efficiency is sacrificed for the sake of corporate size and diversification.
Something to think about as Sandisk officially takes its place among the market elite. We'll catch you next time for The Deep Dive.